So great. Well, welcome. We found this great space last year. We had this here last year. It worked so well. So here we are again. Thank you for joining us. I think I know a lot of you. For those who don't know me, I'm John LaBarca. I'm here with my colleague Jeff Schmidt. We're the directors of investments at Vision Capital. We're going to talk about markets, the economy tonight. Before I get into that, I'd like to just spend a couple minutes just giving a brief update on our firm. So we're excited to begin our 26th year in business. We've grown to 15 employees now. We are serving about 600 client families and managing their collective $1.2 billion of assets. Thank you. Thanks. We've worked hard on our succession planning as a firm to ensure that we can serve you all for many years to come into the future. So we are now up to 13 shareholders. And I'd like to just thank our team and acknowledge them, in particular our newest group of shareholders who are here tonight. So thank you all. Most of them are in the back, so if you'd maybe just wave. Our growth has been intentional, I would say measured, and the vast majority of our new clients come to us as referrals from existing clients. So we thank you for the trust that you put in us. There's really no higher compliment we can get than when you guys refer friends to us. So again, thank you for that. So tonight we're going to talk about the markets again, the economy, investment portfolios, but our services do include both investment management and financial planning. So remember to stay current with your advisor. There's been a lot of recent changes in the tax and estate laws with the new bill, so there's a lot of opportunities for planning and to come up with some strategies. Okay, for our agenda, I will go over a little bit about just the markets, what's been happening, kind of a quick update there on what we're seeing. Then I'll get into the big question everyone probably has on their mind, artificial intelligence. Is it a bubble? Is history repeating itself? How are we thinking about that? I'll then turn it over to Jeff, and he'll go over an economic update and our outlook overall, and then we'll open it up for your questions. But feel free, we'll probably save the questions till the end, but if you feel free to stop me or raise your hand if you'd like me to clarify something as I go. If I'm not clear about something, there's a question on one of my slides. Totally fine to raise your hand and ask. Okay, so what's happening in markets? As you can see here, 2025, very strong year across all markets, really. The S&P 500 was up 18% for the year, reaching a new high around the end of the year. And that's despite all the volatility we saw in the spring around the tariff announcements when markets were quite crazy in March and April, but it's been a real strong recovery. This S&P small cap index finished the year up 6%, so lagged behind the large cap stocks once again. However, in the last 6 months, which includes the start of 2026, so really August through kind of the beginning of February, the small cap 600 index is actually up 20%, and over that same time, the S&P 500 is up about 9%. So really a big catch up here more recently. And so looking at that total period of about 15 months or now 14 months, I guess now, the large cap and small cap indexes are kind of close to each other in performance. So a real change we've seen more recently. It was also a really strong year for international stocks. That was a big story in 2025. Significant outperformance in those markets, led by South Korea, Japan, Taiwan, a lot of the Asian markets were very strong, as well as Europe. The developed markets index, which accompanies a broad group of those markets and countries, was up 32% for the year. That gap above the S&P 500, so that outperformance gap, was the largest we've had in over 30 years. So pretty noteworthy year in the international markets. Some portion of that was from the foreign currencies being stronger against the dollar, but a large part of it was also just strong local market performance as well in those areas. The bond index was also strong in 25. Again, across most assets, very strong. Bond index was up about 7% for the year, and that was the best performance since 2020. So that's a nice bright side there to have better bond performance for the first time in a while. Really, the message that we take from 2025 was that diversification in our investment portfolios is still important to have long-term success in investing. Sometimes we forget, prior to last year, it had been quite some time since international stocks were that strong. So it's a good reminder. Okay, so AI excitement drove markets in 2025, and it was not too dissimilar from what we saw in 2024 as well. What we have here is a chart we put together. It's our estimate. We broke all of the companies. We went through each company in the S&P 500 and separated them into two groups. Those companies that are seen as being beneficiaries of AI technology, and all other companies. So whether they might be hurt by the technology or just not really impacted, or in the non-AI related bucket. So by our estimates, about 2/3 of the gain in the S&P 500 last year can be attributed to the AI theme. And you can see the line here throughout the year is the performance of the two groups. The average performance of the stocks that are not tied to AI was quite muted. The median performance, actually, those stocks were up about 5% only for the year, and the companies that are tied to AI or beneficiaries of AI were up 23%. So you can see the big difference there, right? The 5% performance is kind of in line with what we experienced from small cap companies, which I mentioned earlier, were up about 6% in 2025. So not too dissimilar there. So after 2025, seeing that, and again, 2024, similar, leads to the question, is there a bubble in AI? You know, we're experiencing all of this excitement. So I'd like to start with this quote you see here. Ours is a remarkable moment in world history. A transformative technology is ascending, and its supporters claim it will forever change the world. To build it requires companies to invest a sum of money unlike anything in living memory. News reports are filled with widespread fears that America's biggest corporations are propping up a bubble that will soon pop. So it sounds a lot like the world we're living in today, right? Well, it was actually written to describe the rail build-out in the United States in the 1800s. So the quote is from Derek Thompson, who's a well-known financial writer. But you know, his point was that this idea applies to that period. It can apply to today. It also applied to the late 90s. Right? We see this phenomenon again and again. When there's a new development, there's a lot of excitement. It often leads to bubble periods in markets. So this chart here shows capital spending on various infrastructure build-out periods historically in the United States. So we wanted to put the spending we're seeing in some context historically. You see on the right is 2025. That's really capital spending on AI infrastructure, all of the compute power to build up training and running of these models and AI technology. So you can see we reached about 1.5% of US GDP last year. So we've already surpassed a lot of these previous periods of great infrastructure build out, including the dot-com era. So that measures the year 2000 was about 1%, a little above 1% of GDP in building out the broadband and telecom network that was part of the dot-com bubble. So the data center capital expenditures also expected to reach about 1.4 trillion by the year 2030, and that's up from 400 billion last year in 2025. So if that comes to fruition, that would represent growth in spending of almost 30% per year for over the next 5 years. So at the end here, you see this quote, a famous investor, so different than the quote I just read, but this famous investor once defined bubbles as excellent fundamentals euphorically extrapolated. So what this chart shows, right, so far is we have the first part of that quote. We have excellent fundamentals, right? There's a lot of spending taking place to build out the infrastructure. And there's a lot of companies that are benefiting from all of that spending. So we have that part. The important question for investors really is the second part of that quote is this being euphorically extrapolated? Right? And by that we mean, can the reality ahead meet the very high expectations that are being set up here? So the key question is, all of this spending, will it be monetized? Will there be an economic return on it to justify all of the investment and continued investment? And really, I wish I had a crystal ball. It's very hard. We can't predict if sufficient revenue will be generated by all of this spending to justify it and to continue this, right? We need to see that economic return. What happened in the 1990s was that the revenue failed to materialize fast enough to justify continued investment, and the investment slowed pretty dramatically, and we saw the deflation of the dot-com bubble. So Sam Altman, who's the CEO of OpenAI, has even said, we'll build this system and then ask it to figure out a way to generate an investment return from it, right? So they're not even exactly sure how this will go. They're not really sure of the exact business model. They're trying subscriptions with varying levels of success so far. Some are starting to try advertising models, also varying success and very early. We'll see how that goes. But thus far, it's proven very difficult to charge enough to cover the very high cost of building all of this technology infrastructure. Many of the use cases so far appear somewhat frivolous, I would say, especially on the consumer side. And that's where most of the activity has been focused to date, is really consumer applications. Right, and again, a lot of these models are free to use at some level. There's a lot of them competing for consumers' attention and time, and it gets hard to charge when they can move from one to the next quite easily. So really, no one knows the answer to these questions. So we must invest with humility. The best we can do is use our judgment to observe the environment that we're in when we make our investment decisions. We also don't know who the eventual winners will be from all of this, right? A good example, again, is the dot-com bubble in the 90s. The winners generally were not the first mover companies like AOL, WorldCom, and Nokia, but those that came later, like Google, Facebook, and Apple. So this chart you see here, this graphic, it's been in the news lately. It's not really too important in all of the details, but what we're seeing is this circular nature of business deals recently. So you have two-way transactions between companies, and it was a real characteristic of the dot-com bubble, and we're starting to see some of that again. That's often a warning sign to investors. The largest companies are providing a lot of support for the market. For example, NVIDIA, which you see here in the middle, has invested a lot of money into OpenAI as a leading investor. OpenAI then takes that money, sends it back to NVIDIA to order chips, right, to use. So when we see this, it just leads to these types of arrangements. It leads to questions about the sustainability of what's happening, right? It's debatable if the new AI companies could afford all of the needed investments and infrastructure spending without these types of investments from these companies, from the biggest companies. So whenever any business needs to financially support its customers, it should lead to questions just about the sustainability. So the buyers of all of this equipment and build out, they need to become financially viable on their own for this to continue. And they need to have constant spending and investment in technology to do that. So again, that's kind of the key question. A lot of the, again, the usage that we're seeing is being subsidized basically today by money-losing companies, right? And they're getting investments to use to subsidize all of the use. So the question is, how long will that continue until these companies can reach profitability? Well, we don't know. OpenAI is predicted by some, including themselves, to reach profitability maybe by 2030. The latest forecasts were that their revenue as a company should reach about 200 billion, hopefully, and that's, again, around the year 2030. But by the time they get to 200 billion of revenue, they will likely have invested over $1 trillion of spending, on infrastructure and hardware and everything that goes along with it. So again, there's big unknowns. They could get there, right? It's amazing technology, and it's going to change the world in many ways. It's not on this chart, but another similar characteristic we're seeing, there's a new type of company that's been in the news recently being referred to as Neo Labs. So these are research and development labs, and they're run to create and fund new ideas and businesses and products. So we had a similar concept in the 1990s. They were called incubators. Some of you may remember them. It's the same idea. These companies were somewhat at the epicenter of the dot-com bubble. A lot of them came public and reached astronomical valuations and became sort of public venture capital companies almost. So today there's dozens of these Neo Labs that have been so far valued at over $1 billion. And some have even reached tens of billions of dollars without any business or product or revenue yet. There's an example recently in the news of a company called Thinking Machines Lab, which is one of these. It was started by 6 founding employees, most of whom came from early days of OpenAI. They raised about $1 billion, valuing their company at $12 billion. Again, didn't have a business, didn't even have an idea yet for a product or a business, but the hope was they were very smart engineers. They would figure it out, right? They would figure something out in the space of AI, and we want to invest in them. Well, shortly after their funding raise, 3 of the 6 employees reportedly left the company. They still had not launched a commercial product. So anyway, my point is these are the kind of signs we see that just worry us a little bit, and give us kind of flashbacks to other periods. Okay, so with that said, the other part of this is the environment we're in today. What's the backdrop of all of this? Well, stocks are historically expensive. So what you see here is the multiple of the S&P 500 compared to an annual year of earnings. So right now we're at about 22 times earnings for the index. So not quite at the 1999 levels when the markets got really crazy. You could see in the 1999 here in the chart that we got into the high 20s, almost 30 times earnings, right at the peak of that bubble. Many of the direct dot-com businesses were much more expensive than that. But at the index level, you can see the peak near 28 or 29 times. One issue we have comparing today to that period is that most of the largest companies involved in AI and the AI model, large language model building companies remain private today. During the dot-com era, almost all of the major companies had come public. So another exercise we did, if you were to take these large private AI companies today at their current private market multiples, and we know what those are, today's S&P 500 multiple would look pretty similar to 1999, right? So we'd be in the high 20s if you took a handful of these companies and added them to the S&P 500. And that would make it sort of a more comparable apples to apples comparison. So a lot of similarities and some uncertainties, make us overall cautious on certain areas of the stock market. We think there's a reasonable chance we're experiencing somewhat of a bubble at risk of deflating. Again, we have to invest with humility. We don't know exactly how this will play out. There's a chance it goes much better than last time. The technology, we're not saying the technology is bad. It may very well be extraordinary technology. It probably is. It will lead to large productivity gains in many industries. The question really is the pace of adoption, right? You can still set up for big disappointment if it doesn't play out and monetize as quickly as investors are hoping. And that's, again, kind of major question. So we have been shifting some of our investments to other areas of the markets, to manage our risk, just so that we don't have too much exposure to technology and to this risk if the market environment changes. We don't know when it might change or what might cause that change. It could be something like a change in the funding environment, right? I mentioned like a lot of these money-losing companies are subsidizing the use of the technology. And to be able to continue to do that, they need to be able to continue to raise money easily from investors and do another round and another round of financing, which they've been able to do. And it sounds like that's still the environment we're in. That can change. We don't know when, but it could change, and that would change things. It was about a year ago. Another possible change could be, a new technology that's more efficient to utilize AI. Last year, we had a development around now. There was a company in China called DeepSeek, and some news came out, right, that they had come up with a way to build a large language AI model for way less money than was being spent in the United States. Turned out to be not totally true, and the worries were not totally well-founded, but it could be a development like that where there's a breakthrough, right, where costs start to come down, which, again, you'd be in a scenario where there's a lot of overspending if there's new technologies that are a lot cheaper and more efficient to do this stuff. So again, just to be wary of risk. Everything we do is risk-based. We focus on risk. We want to. Everything is a trade-off, risk and return. And when we have good potential for return without a lot of risk, that's great. When we have it, but you have to take a lot of risk to get it, not as good. So we need to be cognizant of that. The market, the S&P 500, as we've told many of you before and we've said, has become a lot more concentrated in technology than it's been historically. I think the technology sector and information services, if you add those together, which is basically all of technology, is almost 50% of the S&P 500 now. So that's a lot higher than it's been historically. So now I'm going to turn it over to Jeff. So he'll talk a little bit more about some of these other areas of the market that I'm sort of hinting at. He'll give us an update on the economy and our outlook.
Thanks, John. Good evening, everyone. I'm going to switch gears to economics. It's a little bit more dry than artificial intelligence and bubbles, but very important nonetheless. And we're going to focus on the economy more as how it's evolving and where we think it's likely to go, as opposed to being descriptive about what the last 6 to 12 months worth of economic status has been. And so we'll start with this chart, and I'm really going to highlight a little bit of a triad of support, if you will, for the economy on a go-forward basis. One of them is monetary in nature, and the other two are fiscal in nature. The first thing that's really important is that we are in a interest rate lowering cycle. So the Federal Reserve controls short-term interest rates in the economy, very, very short-term interest rates. I'm going to go ahead and refer to those from here on out for the rest of this presentation as base rates. It'll help the charts ahead. And these are rates that have a tremendous amount of influence on personal consumption in the form of car loans, home equity lines of credit, very large consumer expenditures for borrowing. They also are the primary way that businesses borrow capital for most businesses. Most of those businesses operate on some sort of stack of a short-term floating rate loan. So small business loans can often be floating rate. A lot of bank revolving lines of credit for businesses are floating rate. Really, the only fixed rate stuff for most businesses is real estate related. So the fact that we are now in a rate lowering environment is conducive from a monetary standpoint for borrowing and investing, both at the consumer front and the business front. Also on the fiscal side, we've got some tax stimulus coming that a lot of people aren't aware of. I'm going to probably wake up to a lot more to that here in the very near future. On the consumer side, on the personal tax side, we've got tips and overtime being retroactively applied to 2025 for the coming tax returns in April. We've also got a larger SALT, state and local tax extension. And then on the business side of it, we've also got accelerated depreciation, which provides temporary cash tax relief for businesses to get going on certain types of expenditures. So two big fiscal related things coming here in the near future. Also important to note on the consumer side is that this may cause people to lower their withholdings now that they know they won't owe so much tax. So it could be two front, retroactive to 2025, and then another boost of lowered withholdings for 2026. And this chart up here shows GDP broken down by the three major components, which is personal consumption, business spending, and then the government spending. The government spending is for goods and services. It is not transfer payments like unemployment benefits and such. And what I want to highlight here is that the government piece, which is this light blue line, in the years following the post-pandemic recovery, which you see personal spending and business spending really having strong amounts of growth in the post-pandemic era. But government spending on goods and services was rather weak. In fact, it averaged only 1.8% growth during that period of time. And there's a lot of things that have been put in to law over the last few years and things that are going into law here in the future that are going to cause a secular tailwind in federal spending, but also at the state and local level due to aging infrastructure from all of the state and local owned infrastructures that have been out there for so many years now. So we've already got this fiscal government tailwind that's been being created, and it's going to continue to provide an additional benefit going forward. So on the monetary front, the first of the three supportive economic forces on a go-forward basis, this chart is a way of describing what we call the real interest rate in the economy. So if we take the base rate and we subtract inflation, the rate of inflation from the base rate, we get the real interest rate. And that's really important because you notice that the real interest rate, so the interest rate minus the rate of inflation, has changed a lot over time. Back in the late 90s, the rate of interest exceeded the rate of inflation by around 4% for quite a long period of time. So it's a positive real interest rate. But in the years following the great financial crisis, the real rate of interest, the rate of inflation exceeded the rate of interest by quite a bit for a long period of time. In fact, we had as much as minus 2%, so negative real rates of interest. And then, of course, we had very, very low negative real rates of interest in the years subsequent to the pandemic. And this is important because as we've gone through the raising of interest rate cycle to fight inflation, the Federal Reserve raised base rates from 2022 all the way through 23, 24. We've been experiencing the highest real cost of borrowing since before the great financial crisis. And that's not surprising that we've also seen some industries like consumer goods, residential housing, industrial production, agriculture, all these industries that are that are heavily reliant on the extension of credit and borrowing have struggled. Even vertical retail has had worse financial results than during the great financial crisis. So this is some evidence, some descriptive factor, I should say, as to why those credit-sensitive industries have had struggling periods of times over the last couple of years. But you can now see that this line is declining, and that's because we are lowering the base rates in an absolute form, and inflation is still supported and elevated, and so the real rate of interest is now falling, and we're getting back into a below average real rate of interest, which should be a tailwind for businesses who need a lot of credit. Staying still on the monetary side, staying with the base rate, but swapping the inflation rate for the growth rate and nominal GDP, we can also look at how tight monetary conditions are or how loose monetary conditions are. So if you are funding your economy, for instance, at a rate of 2%, and your economy is only growing at 1%, then you have a little bit of a problem. If nominal GDP can be thought of as basically the return on your economy, almost like the return on your assets, then anytime the base rate of interest exceeds the rate of growth or the rate of return on your assets, you're having a destruction of what we call economic capital surplus. And so this shows over time the difference between the growth in nominal GDP and the base rate, which has averaged around 2.5%. So in other words, on average, over boom cycles and bust cycles, the rate of nominal GDP has grown in excess of the base rate in the economy by 2.5%. And that makes perfect sense. You can't fund your economy at a higher rate than you can have a return on it. But you can also see here, again, talking about the last couple years in many credit-sensitive industries that have struggled, is that the difference between these two figures has been on the low side. And that's because interest rates, again, were higher, but the Fed is now lowering those interest rates, nominal GDP still being supported. And so we're getting back into a mode in which it's going to be easier to fund businesses, and that businesses, nominal GDP is able to grow at a rate that is not being detracted by the cost of borrowing. So easing will support a larger gap between the growth rate in GDP and the cost of funding the economy. And the purpose there, of course, is to ensure labor market demand. A mini recession in some of those industries that I've talked about. This is a chart of U.S. industrial production, so just the industrial part of the economy on a year-over-year growth basis. That's on the left axis. And the right axis is a survey data from the Institute of Supply Management. And this survey is for new orders in the industrial sector, new orders for mostly equipment and things of that nature. You can see that in the post-pandemic era, we had this big recovery, and then we had industrial production really fall off. In fact, it was negative for a few years, or flat at best. And that's not surprising given the results we've seen in a lot of those industries. Again, the high real cost of borrowing. The cost of funding the economy was roughly equal to the rate of return on the economy. But we've also seen that since monetary conditions have started to ease, that industrial production is responding a little bit. And we've also seen a huge tick up in this survey in the form of new orders, which means business spending is already responding to a better real cost of borrowing environment. I'm going to switch gears from the economic part of it and throw in two topics that are adjunct to the economy and the financial markets, capital markets. And the first issue we're going to talk about is the fiscal debt. and how it's influenced our view on interest rates. How did public debt become problematic? Primarily, it's done through running deficits during periods of economic prosperity. When you have expanding economies and economic prosperity, tax revenue naturally goes higher. You don't have what we call programmatic and automatic stabilizer spending going in, so you don't have outlays going higher by very much. And so it should be a natural tailwind that if you have a budget deficit, it should decline or improve during periods of economic prosperity. So that's the first way that you have a debt problem, is you end up having greater amounts of debt going into crises like a financial crisis. We had quite amount of debt going into a financial crisis. So therefore, when we had to deal with that financial crisis, we had to issue that much more debt to deal with the financial crisis, help the population with unemployment benefits, stimulate the economy. And then in the years following, we also, even in expansionary periods, continue to run deficits. And so we had another rather large amount of debt outstanding going into the next crisis, which was a health crisis with COVID-19. And then once COVID-19 happened, we had an unprecedented amount of programmatic plus additional social spending. In fact, it was equal to 10% of GDP, a number that's in our history, monetary history, has never occurred. And since subsequently, the political willpower to balance the primary budget just seems to not be there. And so what ultimately happens is that net interest, of course, with a larger amount of debt outstanding, is going to continue to become a higher portion of the tax revenue that you bring in each year. So it's cutting away from the top of the funnel, if you will, of the revenue that's coming in. And that's going to cause an ever-increased amount of debt being issued each year. So the debt pile is going to grow higher and higher. And that's where the interest rate situation could become more visible. So in 2026, the United States Treasury is probably going to issue gross debt, meaning new debt that doesn't exist yet, plus the refinancing of old debt that has come due, to an amount that equals 40% of nominal GDP. That number will rise to 46% of nominal GDP in 2033. So just some perspective there. The actions that we have already taken, even further back than the last year, is twofold. One is in the fixed income and our interest rate investing. The maturity, the amount of time in which we invest capital, we have kept very, very near, as opposed to farther out. That means that if long-term interest rates rise, we'll be able to reinvest our assets rather quickly at much higher interest rates, rather than not being able to reinvest those assets because they're still a long time to maturity. And we've also, as you know, added gold to the portfolio quite some time ago, which is also somewhat related to this, and I'm going to talk about that next. So two things there that we've already sort of preemptively been addressing with this issue. We have put a lot of work into this issue. It continues to be extremely on top of our minds. And what is going to cause us to take further action from the actions that we already have taken thus far? Well, certainly how markets are priced is going to have a lot to say about that. For example, if long-term interest rates go down a lot for a specific reason or two, that may cause us to actually even bring in our interest rate exposure of maturity even closer than it is. So market pricings of that nature are going to have a lot to say about it. We'll also watch the results and the post-result developments of the 2028 election, and that may have some determination on the impact that we may have with future action as it relates to this issue. Okay, gold, another piece that has been heavily in the news. How should we think about gold? It's a precious metal that has a consumer application use, of course. but it is also, its predominant form is that it's a currency, but it doesn't carry an interest rate, unlike other currencies do. In other words, remember, if you, whatever form you hold your wealth in, you're getting an interest rate. And if you hold euros, you're getting a European base rate. If you hold dollars, you're getting a dollar base rate. So gold is like that, except it doesn't carry an interest rate. And so that means that mathematically, I'm going to focus how we can think about gold in a couple of ways, but only from the standpoint of mathematics. And so that means that gold, the value of gold, should increase or decrease with future inflation. It can also increase or decrease based off the perceived future riskiness of a currency. This chart here focuses on the first issue, which is inflation. And what it shows is the price of gold on the left axis and the ratio of the money supply to the value of nominal GDP. So in other words, you add up the money supply and then you divide it by the total value of all the output of goods and services in the economy. And so if you think about it for a second, if the money supply is growing at a rate that is faster than the rate of growth in the economy, then that means naturally that the currency is being debased. Its purchasing power is eroding. If the money supply is growing at a slower rate than the economy, then the value, the currency is not being debased. It's actually gaining purchasing power. And so we see this relationship, this directional relationship at least, rather closely here. These two things have largely followed that way of thinking over the long run, I should say. You've noticed that there has been some decoupling here as of late. We have the money supply now growing at a much slower rate than nominal GDP. So there is some decoupling here of what the price of gold has been doing and how this mathematical exercise compares to that price of gold. It's important to note that the price of gold, this action, is rather commensurate across all currencies, developed currencies, emerging market currencies, and even frontier currencies. So that's an interesting point to bring up. This is happening across the board. Also, as it relates to inflation and economics, another way to conceptualize the concept of the value of gold is through the understanding of the real interest rate that we discussed earlier. This chart shows, again, the price of gold on the left axis, and then the real interest rate that is observed in the price of the United States Treasury market, but inverted. So instead of being from high to low, it's from low to high on this axis. And you can also notice that the price of gold over time, over the long run, has followed the movement of the real interest rate in the 30-year Treasury market until recently. The real 30-year rate of interest is going higher, yet gold continues to go higher. And assuming the sovereign that backs a reserve currencies is expected to remain in good standing, the higher the real interest rate climbs, the lower the price of gold should be. The more negative the real interest rate becomes, the higher the price of gold should be. This makes sense. If you borrow at 1%, but the rate of inflation is 10%, then you are effectively borrowing at minus 9%. If you are borrowing at negative percentages, then the currency is being debased. So what now with gold? The price of gold expects that the money supply will grow faster than GDP and that real interest rates will be negative in the future as opposed to continuing to go more positive. The price also expects this to be true in all economies, developed, emerging, and even frontier economies. As I said, the price of gold is consistent in every currency, against every currency. Could the price of gold be an expression of the riskiness of global currencies? It's possible, but the riskiness of the markets which are backed by these currencies, like equity and debt markets, aren't being questioned in the same way. The reason why we put gold in the portfolio, as I discussed, was our concerns about long-term inflation, government budget deficits, but also the reason that it had a strong negative correlation against risk assets, which are equities, stocks. But that correlation has been waning as of late, and is become to the point where it no longer carries a risk diversification function in our portfolio. It's much more tied to risk assets than it is not. So we have taken some profits at 5,500 on the value of gold, and we will remain on the profit-taking side into price strength in gold. It still remains a very decent size of our allocation as it relates to a precious metal, around 3 to 4% in most of your strategies. Our outlook going forward. The fiscal and monetary backdrop supports the economy and therefore corporate profits. As we mentioned, the triad, monetary side, lower real interest rates, lower base rates, better funding gap between the cost to borrow and the growth rate in the economy, plus the fiscal support of government spending on the federal side and tax stimulus on the personal and business side. We've got 0.5% of additional interest rate reduction coming here throughout the rest of this year and maybe into 2027. Personal and corporate tax stimulus, government consumption expenditures at all level of government, foreign defense spending to also benefit U.S. corporate profits. There's not a lot of reason to think, we think in averages here, that an average year of stock advancement isn't in store for us with that economic tailwind, and things to continue to come about here in the next 12 months. As John talked about, the main risk to financial markets is a cooling of AI exuberance. They are just an extraordinarily large part of the public market and also the private market. You could have that cooling occur because it naturally occurs, but it could also happen because markets may have an impact on influencing corporate behavior. In other words, if markets begin to treat certain companies' stocks or their outstanding debt that they issue differently because of how they're viewing the future economic prospects of those businesses themselves, then it may in fact influence the behavior about how much money those companies are spending on their AI technology investments, and that may be something that helps kick off a different rate of spending in the AI evolution. A drop in AI infrastructure spending in that way would likely also ripple into other areas of the economy beyond AI. In fixed income, low to mid single-digit returns we expect in rates, and in credit, which are corporate bonds, mid-single-digit returns we expect in credit. That concludes the planned part of the presentation. If we would like to initiate Q&A.
Yeah, so we'll open it up now. Just feel free to raise your hand. I'm going to give one of these microphones to Katie, and she'll bring you a microphone so that we can hear your question better, and then we'll do our best to answer it. So, yeah, thank you. Don't be shy.
Anyone? Surely someone has to have a question. Well, you might have answered everything.
You were expecting me to ask something. I was politely waiting until somebody asked first. So thank you for going this deep into the potential systemic risk of a bubble, right? Now, they're all different. If you go over the case histories going all the way back to even telecom bubbles with the development of telegraph cables, they're each different, right? Is this better? They're each different, and this one's going to be different too, assuming it is one. So I was wondering if you had since you did such a great job on characterizing it, defining it, right? Whether you had a backup slide on, so if it does burst, so what does it look like? I mean, we know AIG isn't going to go down, right? And we don't think Lehman Brothers is, with the equivalent. But it's going to impact the banking and the investment industry somehow. I mean, when we got rid of Glass-Steagall, we made a little pact with the devil on that one. So there's got to be some interlocking stuff that's going to cascade down. I was just wondering if you had a equivalent slide that, what might it look like if that happens? Does it look less of a systematic risk as it might appear and turn into a systemic risk?
Yeah, that's a good question. Thank you. So we don't have a slide to go over that, but I can talk a little bit about that. I would say the banking system is probably in pretty good shape. So, right, we have a very difficult stress testing process that goes on with the banks, right? We didn't have that before the GFC. Another thing that's happened over the last decade or so is that more and more lending has been pushed out of the banking sector. Bank loan growth has been very muted for 10 years, really. We have a lot of private lending, private direct lending, private equity and credit have become huge asset classes, right? Which we're not involved in those parts of the market. We think there could be some problems in the private credit area. There's been a lot of lending to the technology sector in particular. So, it's a good question. It's really hard to think through, how it would play out and where the problems would be. I think that would be probably one area where it would be problematic. But again, very different than the housing GFC, maybe more similar to the dot-com phase because we're talking mainly about technology companies. The biggest ones, like the flip side of a lot of the negative points I brought up are that these are incredibly profitable companies for the most part. Not the new AI companies, but the other companies involved in this space, whether it's Google or Microsoft and Amazon. So it'd be a difficult patch, and some stocks are probably overvalued, and so the stock market probably would be down if we get to that scenario. Probably has some economic impact, some spillover, maybe a recession. But a lot of these companies, again, they were doing great before AI came along, and some of them may actually benefit from AI not, going at this pace. There's some that haven't invested too significantly, and I think there'd be some benefit to a few of those companies. I don't know, again, it's hard to think through all the ways it would sort of trickle through the economy, but the economy's certainly been helped a lot the last few years by just all of the build out. And so I think that would cause a rough patch sort of generally. I don't know if you have anything to add. I don't know if that addressed your main question or if I missed it.
Well, I think it answers it. We don't really know.
Yeah,
We're not
honestly.
really sure.
Yeah.
Which is,
Yeah.
I mean, there's some of the analysts who make money answering these questions who are not giving that answer. We're not really sure. We'll do the best we can.
Yeah, I mean, that's a fair assessment. Again, what we're trying to do is limit the risk in portfolios as much as we can, right? We've been talking about this for a couple of years. It's a real balance. We want to have exposure to these companies. It's, these technology companies, it's like the greatest thing we've ever seen in the economy, right, over the last decade, 20 years. And so it's a balance. It's hard to want to exit all of it completely. So we're tasked with, doing the most reasonable, best job we can. And so, like we said, we've been shifting some of our investments. What does that mean? It means something different, right? Every client has a different portfolio. For clients who have our individual stock portfolios, it means we've been shifting some capital away from the largest AI beneficiaries into more of these traditional industries that Jeff highlighted, where the fundamentals are starting to improve, that are more involved in these industrial end markets. For people who have ETFs for their large cap stocks, which many of our clients do, we historically have invested for our large cap exposure in an S&P 500 index fund for those people. We've recently started to shift some of that capital into an S&P 500 value fund that has way less exposure to the technology sector. And that's intentional to, again, limit our risk, try to invest and have more exposure to some of these sort of old industrial economy related companies that we think are positioned pretty well and have much less risk if this were to turn the other direction. And again, just having a diversified portfolio, low risk, fixed income, having our gold, exposure to international markets. Again, that was a lesson and a message we got from 2025, and I think it'll hold true, even in that scenario. And I don't want everyone to leave here with a real negative view. That's not what we're trying to express. Again, we don't know how this will play out, especially the AI question. But I think it's important to know that we're on top of it and are doing our best that if things do change, that we'll do okay. That's kind of the message that I would take.
Okay, we have a question right back here, and then we can go over there.
So I have a question. There, can you hear me now? Okay. So just kind of simplifying it a little bit, if we just focused on interest rates for a moment, the current administration is making a lot of publicity about pushing rates down. On the other hand, we can all see this ginormous government need for borrowing coming up. What's your basic forecast on what's going to happen to residential and commercial mortgage rates over the next 3 to 5 to 10 years?
Okay, so the question is what do we think about the direction and the magnitude of residential and commercial mortgage rates over the next 3 to 5 and 10 years? So first, let's describe where that rate comes from. Those rates are most closely tied to the 5 to 7 year-ish U.S. Treasury security. It's not a one-for-one kind of deal, but that's the way that we should think about them. And so then the question then becomes, well, what's our forecast for the 5 to 7 year-ish U.S. Treasury security over the next 3 years, 5 years, and 10 years? It's hard to imagine that the 5, 7, and 10 year Treasury rate is going to end up at a much, much, much lower level unless we have, at least at some point, unless we have a rather, a legitimate recession in which you have rising unemployment, you have lower personal consumption, you have weak business spending, you have all price instability, the stickiness of inflation really being snuffed out rather quickly because you have aggregate demand dropping really, really fast. And in that case, it's reasonable to think that you would have lower 5 to 7 to 10 to 20 year U.S. Treasury rates, which would then feed through eventually rather quickly actually, to residential mortgages and commercial mortgages. That's not something that, as you've seen, that we're anticipating as a high likelihood, a recession that is, not a high likelihood. A recession can happen at any time. And therefore, our concern is that rates stay rather sticky where they are. 10-year Treasury in that 4%-ish range has really been range bound there for a while. With the issues of and concerns of inflation still out there, the concern that the central banks may not be ultra focused on inflation as much as they're focused on supporting the labor market would aid also in the thinking about longer term interest rates staying elevated as opposed to coming down a lot. And then obviously the fiscal debt situation is one in which would lead you to believe that it would be hard to get interest rates much long-term interest rates much lower under that circumstance. I hope that answers your question.
Yes. Hi.
The only thing I would add to that would be, again, AI. There's a case to be made, and some people feel that AI might be a real deflationary force in the world. Again, we don't know if that will be the case, but if there's, potentially job destruction out there, those sorts of things, could be deflationary, could be at least somewhat deflationary just as a productivity tool. So, that's the flip side to some of those points Jeff brought up. So I think that would be the one factor that could have the potential for them to be, if it does play out that way, to be more aggressive in lowering rates, and even some of the longer term rates might move lower in that scenario. But that's not, our base case forecast, as Jeff mentioned.
So 2 questions. You use the term frontier markets. Can you give me an example of those? And what is the change in the SALT tax? Because Oregon residents have been kind of getting hosed for the last several years on SALT taxes. The SALT tax deduction, what is that changing to?
Yeah, the limit, I think the limit, one of our planners could probably tell you better, but I think the limit was 10,000, and I think that has gone up to up to 40,000, but I think there's a sliding scale depending on income levels and stuff, but you get a much higher limit in the deduction you can take now in state and local taxes.
So for 25, the return for 25, it'll be 40.
Yeah, I think it's retroactive to 25, so it should be 40 for most people. So,
an example of frontier markets?
Yeah, frontier economy is, so you got the developed markets, which are like the United States, Europe, Western Europe, Japan, South Korea, and then you get to the emerging markets, which are like India, China, Brazil, Indonesia, Malaysia. The frontier markets are just essentially the third extension of that as you get further and further away from the developed markets. So, there's a lot of emerging markets in the G20, like Indonesia's in the G20, South Africa's in the G20. So when you get to, the Philippines, big economies, but are not part of the emerging market G20 type of basket of economies.
Yeah, here we go.
So you were talking about AI earlier, and that quote you gave about the railroads was fascinating. With the railroads back then, a lot of investment went into the railroads. Some railroads went bankrupt, but as the assets were picked up, there was a long-term gain in that industry over a long period of time. So there was a good tangible asset that came out of that was usable for a long period of time. Being in the communications and technology industry, we saw the bubble, which, it rode up pretty fast, but there were still some tangible assets there that could be used for a longer period of time. As I look at the AI model, they're building massive data centers. The shell has got some longevity to it. The equipment and everything going inside of it's where the real cost is, and it has a very short life to it. And so I'm looking at that model, and I'm not asking for answers, but I'm just curious if you have any comments about where is the value of everything that's going to go on there if it has to be replenished at a very high cost every 5 to 8 years.
Yeah, really well said. I mean, that's the crux of it. You're investing in a short-term asset that you have to turn over constantly in order to continue to run the business model that you're trying to run. It's just going to require that there is a substantial revenue base from all of these new companies that really doesn't exist yet. John mentioned subscriptions, advertising. the amount of revenue, new revenue that we're not recording right now as part of our economy, except for the early revenue from OpenAI and Anthropic. There's the business API side of it as well, with which Anthropic does a lot better. But we do know that the revenue has to be really, really, really substantial. This is my own work, but back of the envelope, the 1 gigawatt data center concept. If you should kind of think about it in terms of the cost on a geometric average, so not an arithmetic average over a 30-year period, but a geometric average is right around a $10 billion figure to a year to not lose economic return on it. And that estimate could be, way too high or way too low, but at least at this stage of the game, where we are with the scale of it, maybe in 5 to 10 years it may be different, but right now that's the kind of level of cost that it takes to operate those data centers and provide that service. So naturally that means that the revenue streams that don't exist in really large quantities at this moment have to come in really large quantities at some point, in whether it's in all of us paying a lot of subscriptions to use it, or it's in advertisements, which we know. And we be careful how we think about that, because Facebook, Instagram, Google, Amazon, the advertising markets are absolutely gigantic, much greater than we ever imagined that they would be. Advertising market before social media was very small in comparison, and it is multiples and multiples and multiples the size of what it used to be. So it is not unreasonable to think that advertising could be a massive component of large language model, chats, social interactive AI facilities like a ChatGPT. Advertising could be a massive, massive component to that, and that's kind of what we kind of expect to happen. But we do know that the numbers do have to be extremely large. Yeah.
Just to play off of this some more about the value of embedded infrastructure, we know about the rails and the WorldCom's building billion miles of fiber optics and what came out of it. Warren Buffett has been playing the other side of the game. He sat back and watched what is there that needs to be there to support all of that. Josh hit on it just a little bit earlier about these more stable industries, the stable things that have to support this. You know, there's been a lot of comment about Buffett making huge mistakes in going into oil, into public utilities, into electric distributors. I think he owns the whole Nevada public electricity system, all of those kind of things, plus all of these generators that work off of coal. Who would have anticipated that the government would pull the plug this week on regulating coal emissions? Where do you stand on trying to anticipate those underlying industries and their value rather than chasing the things that are unknown?
Yeah, I mean, that's a good question. I would just point back to some of the points we made. A lot of these industries you mentioned are still, ultra important in our economy, right? They're still the backbone of a lot of what's being done out there, and even involved in, standing up and supporting these data centers. And so, we've been trying to have more exposure to a lot of these sort of older industries, whether it's energy and, materials and industrials and those sorts of things. So we get, I would say, a little uncomfortable when we're investing in the great unknown, so it's challenging as people who look for value, and right, you have to have some confidence in how you're valuing these things. And when it gets into like just conceptual ideas is where things get a little trickier. And Jeff even highlighted gold, right? And that's something that's been important to us. And gold and silver, right? Those markets have been going crazy lately, and it's made us a little uncomfortable. You know, I'd say particularly the last 6 months. You saw Jeff's charts on how we think about gold, how we've usually valued it, and when things start to disconnect and look different, you know, the markets start to get a little more speculative, and it makes us uncomfortable. So, yeah, I mean, we certainly look through lots of these old backbone industries all the time. There's a lot of value to be found there. So.
Thank you for the summary, and to add a little bit diversity and also bring us here locally. Is there anything you would add about our Oregon economy and where we are standing in our local market that you are looking at in a scheme of things of everything else?
Great question. Thank you.
Not particularly. You know, there's we don't have any data that shows that Oregon, or at least Western Oregon, is dramatically different than a lot of other parts of the West Coast. You know, there's obviously pockets in the Bay Area and in Seattle that are direct economic beneficiaries of technology and artificial intelligence, always have been for decades. You know, but the rest of the areas outside of California are what they've always been too. And I think Western Oregon is largely the same way. Obviously, we've had two marquee companies here that have struggled as of late versus their past. There's a lot of unknowns about one of them. It's a long conversation and a long debate as it relates to Intel as a strategic United States asset. And then, of course, Nike, one of the big employers here, and Columbia in vertical retail. As I said, the consumer goods vertical retail areas it's been as bad as it's ever been in those businesses, worse than the great financial crisis, which is really quite something. But outside of those things, there's no evidence to suggest that Western Oregon is worse off or better off than the rest of the country. It's not something that we've noticed in the data.
Yeah, I would also add local investments, not a huge focus of ours, right? A message I keep saying is diversification. So our clients come to us, right? Their incomes are usually somewhat tied to the local economy. They are homeowners, their housing prices may be tied to the local economy, right? So we're going to invest in global markets and try to diversify their wealth outside of Oregon, really. So really not like a huge focus for us, basically, for that reason mostly.
Thank you.
I can hear you. I can also just...
Kind of a little bit along the line of a lot of the comments here, but it seems to me that we have kind of a two-part economy. We've got the new AI coming over here, and we have the rest of the economy that we've all been comfortable with for however many generations here. I've got a son's company that puts in a lot of data centers we've talked about. I'm an old wood products guy from the wood industry that's been around forever and lived with housing. Interest rates, you know, have been paramount in my life. We talked about Oregon and what goes on here. Kind of both of these things have been floating around. Got a daughter that works for Nike. So I'm watching and thinking about this. And one of the things we've talked about, and the interest rate to me still is important, because a lot of this AI isn't making much of a profit. At some point in time, it has to monetize itself, or it is going to fold. But the interest rates control a lot to do with housing. Housing has always been a leading indicator coming out of slow times. whether or not we're in Oregon or nationally. And to me, that's something that I'm listening to everything you've said, and I'm waiting to see what's going to happen with interest rates. And that to me is the biggest thing I think is going to tell us where we're going to go. What's your thought about that?
Yeah, that's a good comment. I don't know if everyone could hear that. Just some questions about kind of two economies. We have the AI economy and kind of the more traditional economy that we're more used to, the maybe more industrial economy. You didn't say this, but there's actually some parts, there's some overlap. When I put that chart up about the companies that are AI related or non-AI, there's actually quite a bit of industrial companies that are in our AI related bucket, right, that have been heavily involved in the data center build outs. Could be utilities, right, trying to power the data centers, those sorts of things. But then the rest of the question was about interest rates and the housing market, right? Housing can be an indicator for the economy, drives a lot of the economic activity. A lot of this seems tied to interest rates, and there's a lot of truth to that, as Jeff talked about. A lot of part of his presentation around interest rates was focused more on short-term interest rates, right? Fed funds rate, overnight lending rates, 2-year rates, those sorts of things. And that's the rate that the Fed is cutting, right? And so a lot of small businesses borrow based on short-term rates, so that's helpful for small businesses, even mid-sized businesses. A lot of consumer lending is based on short-term rates, so some parts of auto lending, credit card lending, those sorts of things. But housing is one asset class that's more tied to longer, midterm to longer interest rates. So you don't get that direct benefit when the Fed's cutting rates. It's not necessarily, it hasn't been so far stimulating housing, right? Because what we're seeing is they're cutting rates. The longer term rates are not moving down, despite all the rate cuts we're getting, right? So the mortgage rates have come down a little bit, but not much. So again, it's hard to see an environment in the near term where the long-term rates are really going to fall significantly. So certainly would help, and mortgage rates just coming down a little bit helps a lot of sectors and gets things going, and just people being mobile and moving again, right, would help a lot of sectors and areas. So we'll see. We're not holding up too much hope that the housing, that mortgage rates are going to come down much more, but we'll see how that goes. I don't know, did that answer your question, Rob? Yeah, yeah.
But as long as it's sticky, I'm a beneficiary of like a 2.6. Be hard to move.
Yeah, for sure. They're sticky as far as we've seen and kind of what we expect in the near term. And people who have 2.7 and 3% rates are probably not going anywhere anytime soon unless they have to. If they have a life event, if they have a divorce, if there's a death, younger families having more kids and need to move, if we get into the high 4s or low 5s in rates, like maybe that's close enough where people start to move more. So, yeah.
So the slide there says that you took some gold profits. Is that in like in bullion or mining stocks or?
That's just our gold ETF holding that we have. We don't own physical gold, but we do have a gold ETF. And yeah, we just took some profits, I don't know, last week, 2 weeks ago when gold reached kind of near its recent peak.
And is there mining companies in your portfolio?
We don't own any gold mining stock right now. That's not to say we never would, but at the moment we don't.
And you briefly mentioned silver.
I did. We don't directly own silver. We've chosen to stick with gold for our precious metals holding, mostly due to the correlation data it has historically, as Jeff hinted at and mentioned briefly. Silver historically has been more correlated with the economy. It's more economically sensitive than gold. And so when we've tested it in our portfolios, it doesn't provide the same benefit because the price of it tends to maybe go down a little more when the economy is struggling, where gold is sort of the opposite. And that's really one of the reasons that we've had gold, is that negative correlation to stocks and parts of the economy. So, yes, Mary.
So speaking of the bifurcation in the economy between AI and new technology and what we have, how do you I'm thinking of, I mean, it wouldn't be the same, but if you were to think of the economic crisis in 2008, how did you guys deal with that? What do you do when you know, uh-oh, things are all over the place? What is your kind of strategy for money at that point to move it around and keep it safe?
Yeah, it's a good question. I don't know if people caught the beginning of that. Just to, going back to 2008 and the GFC, and what's our strategy? How do we deal with things when there are really rough periods in a crisis environment? Maybe a bad recession. Ideally, obviously, we'd like to see it coming ahead of time and prepare fully ahead of time. Right, but the main thing to us, again, I just come back to sort of assessing the environment, the investment landscape and environment at all times, and trying to avoid the riskiest areas, right, that could be the most problematic. It doesn't mean we're gonna, our portfolios won't be down if the market's down big and we're in a recession. We know markets always recover. The key is to not get hit too hard when you do get those declines, right, which means really avoiding the epicenters of where the problems are. If you invested, in 2006, 7, 8, 2009, 10 through that, and you didn't have a portfolio that had a ton of exposure to real estate, housing, and financials, your portfolio was down, but it probably recovered pretty quickly, and you probably did okay through that multi-year period. And that's generally our philosophy. The way the math works, if you lose a lot of money and you're down a lot when the market is down, it makes it hard to recover, right? When you start at 100 and you lose 50% and you're at 50, you don't need a 50% gain to get back where you started. You need a 100% gain, right? That's how the math works. And so the key is to limit the losses as much as you can. And to us, that just comes back to avoiding where the excess is. And so we do a lot of research to try to figure that out, right? Which is why we're highlighting AI in these areas of the market that could be risky and problematic. Is that helpful? Answer your question?
Kind of looking at the picture of the AI versus non-AI and the idea that AI might actually solve its own problems. How do you think it'll solve it? Do you think it'll change its own market? It will create a separate market. It will solve its problems not by trying to make more money, but by decreasing its cost, making it more sustainable.
So make sure I follow. So are you is the question, are we able to scale the cost of AI into the future to make it a much more sustainable and durable economic asset?
As one solution, do you think AI might come up with something completely unforeseeable? Do you think it'll solve its own, or do you think it'll be a human thinking process that solves the problem or any problem that comes up?
I would say that the highest likelihood is that it's probably going to be a joint solution. I think one of the areas that AI is going to have to be much greater of a use case, an effective use case, is the utilization efficiently of energy. So figuring out ways to effectively use the energy that's available right now to us in a much better way. Understanding how to navigate the grid and its production at any given time in a much more effective way. We are going to have to increase in electrical production at a rate that we've never done before over the next 5 to 10 years. It's an energy problem. Having generative AI that can find inefficiencies in a system that is already rather inefficient, especially as you add more power, different types of power generation to the grid, is probably going to go a long way in unlocking a lot of inefficiencies to help fund its own power. I think there's high likelihood of stuff like that. I think AI can certainly be used to figure out more efficient compute and being able to produce more and more amounts of inference without increasing the use of electricity as much. So declining marginal returns on electricity, so to speak. So it's probably going to be a positive feedback loop over time, people to AI, AI to people, people to AI in a positive way. And I think that's an important part of what we're trying to say here. And I think what several people have sort of asked is that just like all these bubbles, whether it was the railroad, the Industrial Revolution, the build out of the 1990s, we are still benefiting from the technology and the capital and the disruptive innovations that were born in those eras. And that's why it's so important to go back to the quote, which is, it's excellent fundamentals euphorically extrapolated. This is a snapshot, a moment in time where we just get a little too far ahead of the actual economic benefits. And that's a natural occurring thing. It's just how it naturally occurs. It's just in our position and investing money, we have to make sure that we're identifying those excesses and those risks because that's our job, and making sure that we're able to produce returns and limit downside risk when certain things like this happen. But I think it's important to reiterate that there is going to be some triumphant benefits for decades to come by the technology and the trillions that are being spent. And I'm sure 20 or 30 years from now, we'll look back on it all and realize that we are still benefiting from those trillions. We just might have to go through a little bit of a adjustment period in the capital markets before we just get to enjoy the benefits, so to speak. I think that from my research, I think there is an enormous amount of optimism about the immediate implementation of artificial intelligence in power generation applications right now. And I think there's already a huge push. There's a ton of investment that's going. It's kind of a hyperdrive thing where a lot of grid operators, power producers, power developers are investing a bunch of money to get artificial intelligence inside their enterprise operating systems of how they run the grid to try and get better intelligence, better understanding of how they can move power around and squeeze, not waste any bit of voltage in a grid in a much more efficient way. And we know that there is a lot of inefficiency and a lot of loss in the grid. It's old technology. Everything is unconnected from the other, and so I think there's an enormous amount of optimism there.
Awesome. Thank you, everybody, for your questions and for coming here tonight. There are so many things that could be discussed, and so please reach out to your CRM, and we would be glad to connect you as well with our investment team. If you have more questions, we'll be sure to ask them and get back to you. But thank you so much for attending, and we appreciate it. Yeah.